It's 5 o'clock in London. It's midday in New York, midnight in Hong Kong, 4 a.m. in Sydney, 9 a.m. in San Francisco, 10:30 at night in Mumbai. Greetings. Good morning, good afternoon, and good evening, depending on where you are in the world today. Welcome to this, the latest IPO-VID. My name is Patrick L. Young, the IPO-VID live stream. That is going to be series 34. Episode 4 starts here. And let's get into some exciting mentions of what's going on. CME is going it alone with cash-settled futures, which presumably it feels confident can self-certify and add to its clearinghouse. Back in the day, parishioners may recall PLY, along with Richard Sander and the late great Sir Brian Williamson, were some of the only voices in the West advocating for single-stock futures outside of their Renaissance origins at the Hong Kong Futures Exchange. Can they finally go mainstream in the USA, or will they end up finally finding another issue with their destination in the future? All to play for in the excitement of the single stock futures environment there. And meanwhile, as we look around the world of markets during the course of what's been going on in the past week, in Australia, as predicted, the CEO is departing. You would have known all about that if you were reading IPO-VID's sister publication, Exchange Invest, to which you can subscribe easily by going to exchangeinvest.com. As predicted, CEO Helen Lofthouse is departing after a truly tragic term, which has been blighted, rather like some of her predecessors, alas, by perma failure. Some say even the regulatory announcement came out after the media was already reporting the story. It's another sad chapter in a tale of decline and fall, but the next step has to be wholesale reform, and on that basis, it's hard to see how anybody in the current C-suite or any of the board can credibly survive. Over in India, SEBI are creating a fascinating precedent, throttling new entrants to the options market. It's all a case of first bring your own cash liquidity, then you can add options. SEBI, the Indian regulator, can always be relied upon to produce some fascinating twists on regulatory licensing, as if it wouldn't be easy enough to use the liquidity of other markets in order to provide the underlying pricing for your options at some juncture. Well, anyway, that, of course, leads us to the fascinating concept of our sponsored segment with our good friends from NASDAQ, because investor appetite for Asia is rising, but post-trade friction is holding markets back. In the new NASDAQ Plus Value Exchange study, 25% of participants plan to grow exposure, yet 46% face artificial trading limits. The biggest pain point, corporate actions, 60% report higher error rates, and 39% of platforms are still legacy. The fix is clear: harmonize rules, standardize workflows, modernize technology in order to unlock efficiencies in settlement and corporate actions. For exchange leaders ready to scale, download Creating Asia's post-trade operating model of tomorrow at bit.ly. That's bit.ly APAC/post-trade, APAC-POST-TRADE. Today, I am delighted to welcome our fabulous guest. Igor Pejic is joining us. The topic, Tech Money, a guide to the new game of technology investing. Award-winning author and finance professional Igor Pejic specializes in the intersection of technology and money. Pejic is the author of Blockchain Babel and Big Tech in Finance. He's been a finalist in McKinsey Bracken Bower Prize, and we're discussing his latest book today, Tech Money, which uncovers the new rules of investing in the technology age and teaches investors and executives how to benefit from them. Igor, welcome to the show. Where in the world are you today?
Hello, Patrick. Thanks a lot for having me on the show. I'm dialing in from Vienna, the beautiful capital of Austria.
Vienna, the magnificent capital of Austria. I haven't been there quite recently. Wonderful, wonderful city altogether. So how did you end up living in Vienna, pray tell?
Well, actually, I'm Croatian, but I grew up in Austria, and it was very easy decision to move to the capital, to Vienna, when I started studying. And I never felt at any time that I could leave it, because it's really a great city to live in. And if you look at all of these charts of the most livable cities, Vienna usually tops them, and I think there's enough reasons that it does so. So there's no reason to ever leave.
Yeah, there's absolute justification for that. Hugely civilized city. Also, you've got a fantastic airport in Vienna. You've got an airport not that much further away. I mean, closer than most London airports. You've actually then also got Bratislava Airport, just in case you manage to not get something from Vienna. It's very, very well connected. You're at the heart of Central Eastern Europe. And I suppose also it's very handy because really you're not that far in terms of driving time, even from the relatives in Croatia, which makes it incredibly central.
Absolutely. And if you get into the car within 5 hours, you can get to 5 to 6 European capitals, and you're at the Croatian coast as well. So it's really a perfect position within Europe, plus this unique history that you can see in every corner of the city. So that's a very, very good blend to be in. And if you compare it to the other European metropoles like London or Paris, it's still a very affordable city.
Yes, that's a very, very good point. The affordability of Vienna is quite remarkable, and you can still manage to grab some sensational property at very reasonable prices compared to a lot of other Western locales at different times. So tell me a little bit, Igor. I mean, how did you manage to get to this point where you're a thought leader in finance, and particularly relating to the intersection of technology and technology investment?
Sure. So I basically spent my entire professional life, except some time that I spent as a business journalist, but generally most of my professional life working at the intersection of tech and finance. First, I started in classical management consulting, working with big tech corporations, but also with large banks and international financial institutions. And then moved on to a credit card company where I was heading marketing and product management for some 50 plus markets. And now for almost 10 years now, I've been working for Europe's largest bank in various management positions. But back in 2019, I actually had the urge to do something more in this area that interested me. So I thought, why not leave the day-to-day job and also next to it, do some writing and look a little bit from the bird's eye view at what's going on in neighboring areas and what's sort of the bigger picture here. So I published my book called Blockchain Babel that you referenced at the beginning back in 2019, which was one of the first actually to strategically look at this new technology and what it means for banks and other corporations, because I was dealing with this technology and also with digital assets for quite some time. Then 2023, I published Big Tech and Finance that you also mentioned, which basically looked at how big tech corporations are using these new technologies, such as mobile, clouds, but also blockchain in particular, now blockchain and AI, in order to enter financial services, to expand within them, and sometimes also to lock them or lock out traditional suppliers. And, it set me on a very interesting trajectory. I was speaking a lot and writing a lot, and I was speaking to different kinds of audiences. So it could be university students, freshmen, the other day it was banking executives and across the world, basically. And what I realized is that, they had different kinds of levels of knowledge and maybe also different interests. But there was something that they shared, which was an interest in a specific question about technology and blockchain at that time. And it showed when I was holding these speeches. Usually you would get people asking very smart questions on stage, things like, what will be the new Ethereum update? What about corporate adoption of this and the blockchain? But after it, they would come up to me and ask me, what will be the Bitcoin price? Should I invest in it? Is it too late to get into big tech? How about a new tech shooting stars? Can you explain something? So then I realized actually those people, whether that's the university students of Madrid or the banking CEO in Manhattan, they kind of course, were interested a lot in the technology and where it's heading to. But they were especially interested in, how can this thing help me also in my personal life in terms of a financial benefit. And this is why I, to my shame, I was not able to do any better than to tell them, I don't know where Bitcoin will go up. I don't know what will happen in terms of stock markets. And then I embarked on a journey to answer that question because I wanted to have it answered myself. And that's how I ended up spending the last 2.5 years of my life trying to replicate the methodology from my previous 2 books to answer this new question, how to ride those new technological revolutions, actually to benefit from them myself. That's how I ended up interviewing some 50 plus decision makers, crunched some 50 years of stock market data, and literally read hundreds and thousands of studies and databases and stuff like that. And yeah, that's where my new book comes in, Tech Money, which you also mentioned in the introduction. And I think I didn't expect it to be that much to digest and that much to build up, but I'm quite happy with the result, and I think it can be a helpful toolbox to readers, whether that's retail investors or financial services professionals or investing professionals.
And I'm here today with the fabulous Igor Pejic. We're discussing his new book, Tech Money, which we're going to get onto in just a second in greater detail. Tech Money, a guide to the new game of technology investing. Just so you know, ladies and gentlemen, we're recording this show. It's a very, very busy start to the year. Trying to coordinate everybody's calendars is making it quite tough to do too many live shows, although we have already had a couple of great live shows this year. You will recall we had the opportunity to chat to the head of NASDAQ Europe just a few weeks ago. And amongst other guests, we're going to have more live shows coming in the near future, but I'm glad that we managed to snag a little bit of time in Igor's diary because he provides an elegant complement to previous guests such as Roland Chai and Troy Kane that we've had so far this year. So Igor, I mean, if we look at how your book is put together, explain to us a little bit, because obviously tech investing has been around for a long time and it's been somewhat, I mean, if I may say so, it's been somewhat of a very, very hot topic throughout your life, probably long before you ever had any interest in investing.
It definitely has. So it's, I think it also changes the rules of investing, and that's what interested me for this project in particular. Because when I started, of course, I was familiar with all of the new technologies that were rising. I think everybody is these days. You can't get around what's happening in AI and crypto, in quantum as well, and some other areas. So of course I was aware of this groundbreaking potential, but what I didn't know was that it also had a tremendous impact on the very rules that we've had, or we've actually played by, and most people still play by when it comes to stock picking and investing. And I mean, the book is centered around 100 charts. Right? One of the challenges was, to make it appealing to the retail investor just as well as the professional, and also to, not have it too shallow, but still also have it digestible for people with little time. And that's why I built it around charts. And I have brought 4 of them with me today, and maybe we can show the first one.
Sure, let's go for it.
Answer your question. I think that's why I really love charts, because they tell you so much within just a couple of bars or in one pie. And this is basically a comparison that I took out of the book of the top companies in terms of market cap in 2004 and in 2025. And if you look at the bars, the gray ones are non-tech companies, and the green ones are tech companies, right?
So we've got 2 tech companies and the rest are non-tech companies. Just when people are watching the podcast, as it were, they may not be able to see this. So you've got Microsoft in 3rd place in 2024. The leaders are GE and Exxon, and actually a pretty good distribution, because they're like 0.31, 0.29, 0.29 of $1 trillion. So it's very, very close with them in 4th place. Pfizer, even Citibank 5th, and Walmart 6th, 0.25, 0.23. And actually all the way through the list, you go down to the bottom, you've got Intel and Bank of America, 0.19, 0.18. So the numbers are quite closely together, and you've got only 2 are tech companies. Carry on, Igor.
Exactly, yeah. Thank you for explaining. So today in 2025, for the listeners, what we see is much more green, right? So 9 out of the 10 companies are green, which means they're technology companies. The only one is in place 6 is Saudi Aramco, which of course is the Saudi Arabian oil company. But we have in one NVIDIA, then we have Microsoft, Apple, Alphabet, Amazon, Meta, then Saudi Aramco, then we have TSMC, and we have Tesla. So basically we have all of the big tech company names, but it's not just the composition of the list, I think, that's striking, and this is unfortunately something you cannot see, but I'll tell you the numbers. It's the sheer size to which those companies have grown, right? Whereas GE was heading the list in 2004 with 0.3 trillion market cap. NVIDIA today has 4.3. When I was doing this chart, now it has something closer to 4.5. So it's growing in every couple of months, actually. And so this is like 10 to 15 times the size of what we had back 20 years ago. So actually, we are really living in a new economy, and it's very, very hard to believe that there will be a day when this list will have much less green, i.e., when non-tech companies will enter there. We have a lot of other great companies, Nike, Walmart, BP, all of those big guys, and they can still be very profitable, but they won't be, or I don't see them being the big drivers of our economy. I think if there is new players, it will be other tech companies.
So it's very interesting. I mean, when you look at that breakdown, as you say, huge tech companies, but also the sheer size, which is the thing that you can obviously see when you're looking at the chart. I mean, Nvidia, 4.32 billion, Microsoft, the better part of 3 billion, Apple, over 3 billion, Alphabet, 2.36 billion. So all of the companies 20 years later, the top 4 or 5, any one of them is larger than the top 10 in 2004, which is, first of all, a huge number. I suppose the central bankers should be saying, thank you very much for offering that via QE. And at the same time, though, I mean, the sheer extent, because Nvidia is 4-point-something billion, it's 4 times the size of the 10th largest stock, which is Tesla, still an incredibly hefty company at $1 trillion, whereas they were very closely bunched, 0.31 trillion to 0.18 trillion in the 2004 data.
Definitely. And just to put that into perspective, because it's very difficult to imagine $1 trillion, let alone 4 trillion. We know how many zeros it has, but just to put that into perspective, if you compare it to countries' GDPs, right? Entire nation states, you'd probably get just 2 countries that have a larger GDP, which is the US and China, and maybe Germany, depending on how you calculate and which point in time you look at it. But that means that the entire economic output of countries like France or Brazil, or the output of 1.5 billion Indian people, wouldn't be enough just to buy one company. And this is really massive, because it's much different to what we've seen in the past.
It's a very interesting point, that, and I mean, actually, we've done a number of short videos, because what's also intriguing is that, let's face it, this has been relatively recent in the last few years. I mean, it took us a long time to get through trillion-dollar companies 15 years ago, and then suddenly we had 2 trillion, 3 trillion all fail, and I mean, 3 trillion to 4 trillion effectively took place in the course of, a year, 18 months between 2024, 2025. Quite amazing how that concentrated growth in tech companies has taken place.
Definitely. But to come back to your initial question, it has also changed the rules of how we invest. So maybe we can have a look at the second chart that I brought with me. I have to explain that, especially to the radio listeners. So basically, we have a chart that's showing a comparison of value stocks, so the MSCI USA growth stocks and MSCI USA value stocks, which basically compares 2 types of companies: those with very strong fundamentals in terms of traditional financial analyses, and those that where investors basically price in the growth. And what we see here is a chart showing basically how they compare to each other, those type of companies. And for those who see the chart, the value of 1 means that they're in parity. But what we're seeing here on the chart is since 1975 up to the 1990s, basically, where the value stocks were always or almost always outperforming growth stocks, right? So these were the stocks that Warren Buffett and others were looking for. They were usually doing much better in a longer period of time than growth stocks. But it was close to 1. It was maybe 0.8, 0.9. So the factor was very close to 1. What happened then in the, before the dot-com bubble burst was that we see a huge uptick, and the growth stocks, the growth stock categories basically taking over. So with the rise of the internet and internet companies and the internet economy, it basically shot up. But it didn't just take over, but growth stocks went almost to a factor of 2, which is much better performing. The difference in outperformance is much bigger than what traditional value stocks used to have in the past compared to growth stocks. So you would expect that to go down during the dot-com bubble and the bursting, and there was really, a tilt then again towards value stocks, but still growth stocks outperformed and they continued to grow. Then it crashes again in the financial crisis, still keeping the outperformance of growth stocks. And what happens then really after 2010 or so is that the outperformance of growth stocks really reaches a new level. It just grows into a factor of 2, right? Very, very strong. And then since 2020, it basically went up to a ratio of close to 4, which means that when we saw the rise of new technological revolutions, new technological waves such as cloud computing, mobile phones, artificial intelligence, distributed economy, and we have many others, like the whole crypto sphere is not even calculated in here. So basically the outperformance, just as well as the tech companies, it simply exploded. So it really changed the rules of the game.
Fascinating. I mean, it's really, really interesting. And I mean, yeah, we end up on this fabulous high from the chart from your book, because we're way up towards what, 4.5 or something like that is, which is an incredible ratio to see between different stocks. And certainly it reflects a very interesting history, because a lot of people are talking recently about gold and silver stocks and how incredible it is, but not a lot of people pay attention to the fact that in terms of overall market capitalization, I think mining stocks have now reached virtually an all-time low in modern times. I mean, when I'm talking about modern times, I'm going back to about 1850. They're down to something like 1% of the global market capitalization, because the tech stocks and so on have managed to suck so much investor energy. So you used to be a business journalist, as did Paul Podolsky, hedge fund manager, an excellent guest we had a few shows back. It must be really, really interesting for you to observe what's happening here, and how, therefore, do we make progress towards investing in tech stocks, given the fact that there is an enormous amount of hype and presumably, therefore, a lot of focus on the sector at all times?
Definitely. It's hype. And it's really interesting to see, what's behind the hype. And if you see those numbers, you would actually assume that tech has taken over the economy. But if you look at certain indicators, stuff like, how much is it contributing to GDP, America's GDP in this case, it didn't grow that much. If you look at how many people are employed in the tech sector, yes, it went up slightly, but still not significant. What did change, though, is the capital markets, right? So we have now about a third of the S&P 500, a third of the value is now tied in IT stocks. And when I say IT stocks, it covers mainly tech companies, but it excludes a lot of other big tech companies like Meta, companies like Tesla, companies like Amazon, even. They wouldn't even fall into this category. So the dominance of tech in the financial markets is tremendous. And therefore, your question is absolutely right. How do we separate the hype and whether this is lasting? And it's actually an argument very frequently made by especially value investors, but also other skeptics who say that this is basically all hyped up. It's a prolonged bull run, and eventually things will revert to the mean. Eventually things will go back to the way they were before 2000. But at the end of the day, I'd like to ask them, what kind of bull run has lasted for a quarter of a century? What kind of bull run has really survived and thrived after existential shocks like the bursting of the dot-com bubble, shocks like the financial crisis, which was worse than anything we have seen in the previous 70, 80 years. Also shocks like COVID, a global pandemic. We've seen war in Europe return. Now more recent AI shocks. And still tech, even though it might fall on the short term, in the longer term, it basically went up and up and up. So I think the most important thing to consider when you're investing in tech or thinking about investing in tech is to basically look at the time dimension, right? The time dimension, I think, can reduce most of the risk, because time in the market usually beats timing the market. Means if you are in there for a long time, you usually live through multiple business cycles and multiple tech cycles, and eventually the annualized returns then are above the market average. Of course, that's how it has been in the past. We will see how things will go in the future. That's a different story, but that's what we can tell from current trends. And
so actually that brings us, maybe if I can interrupt you, I mean, that brings you to a very interesting chart, which was actually your third chart where you're demonstrating that alpha impact. And I think it's well worth, if you don't mind, bringing that in here.
Absolutely. Thank you very much. So yeah, I ran a scenario, a fictional scenario, because I was always getting very often getting the rejection from people when I asked them, do you invest in tech? And those who didn't always told me, it's not worth the effort. It's just too much volatility, too much risk in there. So I tried to basically calculate what it would mean. And it was a fictional scenario. So I took fictional $10,000 and I used the annualized return rates of the past 15 years. Which for the S&P 500 was something around 14%. For the IT segment of the S&P 500, it was closer to 20%. And what happens here is that, after 10 years, we already see that those $10,000 have turned into $36,000 if you invested in the S&P 500, and into more than $60,000 if you took the IT segment. But it only gets interesting after 20 years, right? So this is where the compound effect really kicks in. And it's a difference of having $130,000 to $370,000. So it's almost 3 times as much. And then if you look at it for 30 years, that's the time horizon that many investors quote. And then an average investor would reach some $500,000 with those 10K, so which is still a very good progress. But pure investor into the IT segment would end up at close to $2.3 million US. Now that's of course all before taxes and before any fees. But the difference here is tremendous, and the difference is that even a couple of percentage points in annualized return difference causes the years to double to shrink, right? So if you have the 14% of the S&P 500, you would double your investment roughly every 5.3 years. With the tech returns, you would have 3.8, which means that it's really, really a significant difference that you're in the time. Plus, you get to level out all of those ups and downs that can be very striking in tech. That being said, maybe the final comment to this chart, of course, that's all quite theoretical. Why? Because many people don't have the psychological setup to pull through, all of the downs that tech has. Tech stocks can be down 50, 60, 70%. And then it's very, very difficult to have a kind of a contrarian mindset to keep to your stock and to keep believing in this approach, even though this period of time will certainly come at some point.
Fascinating altogether. You've been discussing this with such passion, Igor, over the course of the last 25 minutes or so. So one thing, though, that does strike me is, you talk about technological revolutions. We're going to come to your fourth chart in just a moment. But actually, when you look at the companies we're talking about here, they are quite different, aren't they? And I don't just mean that they do different pieces of technology, but if you look at the company that's been around for a long time, third place in 2004 in the capital market capital ratios, Microsoft 0.29, which grew to a stunning 3.91 billion 2025 when they took the data. Microsoft's quite a utilitarian company, if I may say so. It's just essentially that's a play on zillions and billions of users. In parentheses, I have no idea why they use Microsoft. Having tried to use it last night, I found it an awful system. But it is effectively the utilitarian gubbins that everybody gets a huge subscription income from, which is very different to a company like NVIDIA that leads the world as the super sexy AI all-in maker of these chips, which are probably going to take lots of people's jobs in due course, et cetera, et cetera. And that, complements or contrasts rather with the likes of Apple and Amazon and Alphabet, which are in the 3rd to 5th places, which are all themselves very different hybrid mixes of the type of company. None of them are actually just delivering hardware. None of them are actually just delivering, so NVIDIA is delivering just hardware. Microsoft is a melange of services. Apple is hardware and software and operating systems. Alphabet is really predominantly, although they would say they do some hardware, predominantly about software. So it's a fascinating mix, because you can't just say, tech companies and they're all exactly the same.
Absolutely. They're all quite different. It's difficult to choose an angle to start from, but I'll take the one of concentration that you just mentioned first. So many of those tech giants have diversified very, very strongly, which means they're much more stable, I would say, than what used to be the case in the past. If you think about IBM and Cisco and so on, and they have become much more capable of riding new technological waves and much more open in terms of not really being tunnel vision into their system. Meta is probably the one that's most concentrated, where I see also most of the risks, because the vast majority of their income comes through advertising. I mean, they're diversified in terms of social platforms, but they have quite a lot of existential risks if major countries introduce ID verification for social media usage, or they ban it for kids under 18, which is a very likely scenario these days. Then they have a massive problem. On the other hand, if you look at, you mentioned Microsoft, they don't have just the Windows software and some hardware, but they have diversified really, really well. So they're a huge cloud computing provider. They're big in gaming as well. They're big in artificial intelligence, just like Google, right? Google is also a cloud computing behemoth. Also now very strong with Gemini in terms of AI. So they have become very adept and they've branched out in all kinds of different pillars. And the great thing for them is that at a certain point, those different pillars today are merging more and more, right? So if you're a huge data collector like Google, this gives you a tremendous edge in terms of AI. It also gives you a tremendous edge in terms of cloud computing if you have the best or one of the best AI softwares. So there's very, very strong locking effects, even much stronger than what we saw with pure platform effects, which is also which has been the major engine of big tech's profit machines for a very, very long time, each of them. So I agree with you. They're completely different. And I would also say that probably Microsoft is perhaps the most savvy one in terms of strategy. I think there's a reason why we saw Microsoft back in 2004 and back now at the top of the charts. It was also number one a couple of years ago. It's because Microsoft has always had this multi-technology approach. Plus, it had always multiple and sometimes often competing bets within a technology, right? So even with AI, it supported OpenAI, but it has its own initiatives and it's experimenting with Claude and some other applications. So it was always very, very relentless in getting the best technology. It didn't work out everywhere. It failed, for example, in blockchain, but therefore it was successful in gaming. It was successful in cloud computing. It was successful in video conferencing software. So Microsoft is really, in terms of a company, a rather stable bet in terms of fundamentals and possible shocks.
Yeah, and I mean, then you've got the fact that Microsoft, essentially, whatever that number is, 75, 80% or more of the world's computer users who use a terminal are switching it on and running a Microsoft operating system, which in itself makes a subscription behemoth and a shop window for all manner of opportunities going forward, which has been part of the ability of Microsoft to keep themselves going and as you say, diversify and do very, very interesting things and some great products within that suite. I'm going to let you have a rest for a couple of seconds. I'm very excited. We're going to come to essentially the most exciting chart of all. We're going to be looking at picking winners in technological revolutions. My name is Patrick L. Young. I'm here talking to Igor Pejic. We are discussing his new book, Tech Money, a guide to the new game of technology investing. We're recording this show because of diary constraints. It's a delight to be here. Thank you very much for joining us. If you can, send us a little bit of love. We'd love to have that because, of course, those hearts all help get the AI bots to understand better the useful content we are sharing with you from IPO-VID. One of the things we also do, ladies and gentlemen, we do some short videos, and I'd like to bring you today our short video while we give Igor a slight rest in the middle of the show. And it's very, very worth looking at. Well, a lot of people probably even by now, they're already forgetting the form of non-regime change that allowed President Maduro to swap one socialist republic, the Venezuelan Bolivarian one that he was running, in favor of the Southern District of New York within the Mandami Directorate of Socialism. All change there, but I think a lot of people haven't thought about the fact that it may be all change in one area of the Caribbean, the greater Caribbean area in South America, but further to the northeast could be all change in the Caribbean coming soon. Meanwhile, in Big World, looking at how regime change and presidential arrests affect the world post-Maduro in Venezuela. The big kahuna is, of course, Cuba, with the Havana regime looking ever more of an outlier in a region where some form of capitalism is starting to reign supreme. Cutting off cheap oil and gas may be a catalyst for change to get rid of Castro-era student politics forever, but it also then reorients the entire region, as suddenly the tourist draw in the Caribbean will surely be Havana and all other parts of Cuba, barring presumably Guantanamo Bay, which could grow the Caribbean economy, but short-term probably sees a massive substitution effect, which could suck resources out of the rest of the region. For more in Big World, like or follow. So there you go. Everybody's been watching Venezuela, but the shockwave could be hitting Havana. Don't forget the George W. Bush, an absolutely massive aircraft carrier, one of those nuclear-powered jobs that's about the same size as a small Polish mercantile town, has been doing figures of eights all around the international waters just off the border of Cuba, recently in the international waters beyond the Cuban territory. That doesn't suggest that there's anything other than pressure building up on the regime. And of course, Havana has lost its cheap, subsidized oil from Venezuela. Subscribe to the Exchange Invest newsletter for the latest news updates. Also subscribe to this channel in order to get the Big World short videos, as well as this IPO-VID, such as the one we're enjoying today with Igor Pejic. We'll be back to Igor in just a second. Let me run through our finance book of the week, Technical Analysis in the Active Trader by Gary Norden, who was a compelling guest on last week's show. It exposes the flaws and unreliability of technical analysis. It's a great practical guide to understanding how and why traders will struggle to be profitable using merely charts and indicators if you don't have a little bit of extra riz, ladies and gentlemen. Don't forget, our next book of the week will be unveiled on Saturday in the EI Weekend edition. That's absolutely free, the Macro Read EI Weekend. By the way, you can sign up to that at exchangeinvest.com. But while you're there, why not try a 7-day free trial to exchangeinvest.com, the exchange of information, the water cooler of the bourse business, the world's unique pithy source of analysis and indeed quality analysis at that of the world's bourse markets business all across. Drop in at exchangeinvest.com. It's only $499 per user year, and you'll be helping subsidize the delivery of podcasts and live streams such as this one with Igor Pejic. So back to Igor Pejic. We're talking about his book, Tech Money, a guide to the new game of technology investing. So Igor, let's get on. I'm really excited. I'd like to look at how you pick winners in technological revolutions, and you've got this fascinating slide 4 to share with us.
Certainly, yeah. So basically, that's just another introductory sentence to how to pick winners. The question is, do you want to pick winners, or are you fine with picking tech themes? And of course, a lot of studies will indicate that it's almost impossible to pick the right winners. They will tell you that at least 9, sometimes even more out of 10 hedge funds failed to pick or to outperform their benchmark. But I think especially in tech, it does make sense to, at least with a small portion of your portfolio, try to get it right, because as we've seen also on this chart, the returns can be exponential. Now, this is basically the rise of Gen AI and who the winners are. Now, just a short thought experiment. Imagine it's the year 2022, it's beginning of November, and somebody tells you, there will be this great giant technology that's called generative artificial intelligence. It will take the market by storm, and it will, heave basically the valuations of entire stock market indices. Now the question is, what do you do? Where do you invest, for example, $10,000? Of course, applications are endless. If you go to the application layer, it's very difficult to choose the right winner, especially before the early phase of market consolidation. Then, a revelation hits you and you think, why not go a layer below that, right? A layer more towards the infrastructure. And you think, every company that's using AI will basically have to use computer chips. So if there is the age of AI, why not try to pick the computer chip winner? And you think, which one? I mean, do you pick AMD, NVIDIA, Qualcomm, Intel? There's not so many. That's the good thing. So it's much easier to pick an infrastructure winner in terms of likelihood than one on the application level. But still, a rising tide does not always lift all boats. So it is important to understand the business models, to understand what they're doing. And in terms of AI, it's actually, you could have seen this coming if you understood the technology, if you understood the supply chain. So why was NVIDIA so much performing so much better than all of the others? Well, the thing is that NVIDIA, unlike the others, was concentrated, or it had special knowledge in terms of GPUs, graphic processing units. So there's basically two big categories of computer chips. One is the CPU, the central processing unit. You can think of it as a generalist, as a, coordinating all kinds of resources within the computer. And then you have GPUs, which are highly specialized chips that can do only a small number of tasks, but those tasks they can do really, really efficiently. And it turns out that graphic processing units, they can do a lot better in terms of AI learning and powering those large language models than can CPUs. And this is why NVIDIA, who had the top spots for years and decades actually. When I was a teenager, they were still in the computers. They were the best chips for computer graphics. And they took this edge, and basically the company value exploded. That being said, it's much more complex these days, right? So Intel is rising now again, because the times have changed. Now we're living in an age of where companies and governments seek to insource supply chains and build stuff at home. And Intel, unlike many other chip makers, has fabs, plus it makes the chip architecture, which means that it does what TSMC and NVIDIA do all under one roof. So it has those capabilities that are very difficult to acquire. But my major message here is that you always have to understand, the technology and what it will require, and then work your way back to who of today's companies are best positioned to be there and to deliver this thing. And back in November of 2022, if you had understood the requirements of training LLMs, and if you understood the major chip makers and where their strengths were, then you probably would have had much, much better ride than most professional investors. Because, and then this closes kind of the argumentation from the beginning, no value investor back at that time would have picked NVIDIA, because they would have looked at it and said, their P/E ratios are too high, the total addressable market, it's just, limited, even if they had known about Gen AI. So if you understand the technology, then you also understand that those traditional metrics don't actually work out, and you really have to prioritize the fit of a technology, of a company's tech competence to what the new tech demands. This is, I think, the major competence you need as a tech investor when you're attempting to pick individual stocks.
So run that last bit by me again. The major competence I need as a tech investor when picking stocks is?
Okay. So the major competence that you need as somebody picking stocks is to basically align the competencies of a tech company with whatever is needed by this new technology.
Spot on. I've got it. That's a beautiful clip. I think we'll see that in social media in the near future, particularly as AJ's in the studio doing production today. Totally get it. Very, very interesting. Now, let's just talk one or two, final questions around this thesis. I'm interested. If I'm an average investor sitting at home, do I have to get way ahead of the technology and understand this at the absolute earliest stage? Or where is the point at which I should really be trying to understand the technology in order to pick a stock? Because as you rightly said, stock picking is a very, very difficult game. And of course, in the 1920s, the roaring 20s, the US stock market 100 years ago, if you'd picked the things that were the go-go stocks, which included the auto manufacturers, you'd probably have picked Stutz, Auburn, Duesenberg, companies like that, none of which existed by the late 1930s.
Yeah, that's an excellent question. Actually, as a tech investor, what you should aim for is to look at midterm scenarios, which means the next couple of years, which is sometimes called emerging technology, right? So you have the established technologies where you have very clear forecasts. For example, how many smartphones will be produced in the next year, what the market is, and so on. This is probably not where you want to be in. That's too short term. Then there's the long term, which is more frontier technologies like quantum computing and so on. That's probably too experimental, and nobody can really tell you much about the timeline. But the sweet spot is really, what is coming, what's emerging, things like AI, where you are trying really to understand the scenarios when the technological potential is there, but you're trying to understand the use cases, which will be the most most widely used use cases and which will be the most profitable for companies, and then try to pick the company that is most able to capitalize on this need. And also there's a certain technology cycle that you should pay attention to, which is the technology adoption cycle, which basically tells you the best point in time to get into a technology is when you see adoption rising beyond the early adopters, right? So you have those early adopters, and at one point in time, you have the early majority coming and using that technology. That's somewhere around 15 to 20% of the market. When you see that adoption happening, that's usually the sweet spot to get into a tech and choose your winner.
Okay, so let's try and think this through. How can I spot some of those characteristics? Is that the kind of time when the real enthusiast media, the sort of business to business and even into the business to consumer press is starting to talk about this incessantly, but it's long before it hits the Sunday newspapers or even daily newspapers or whatever websites you're reading? Is that kind of the dynamic we're looking at?
That's true on one hand, but I would say it's important to go beyond simply media interest and also beyond user interest, but really to look at paying users, frequent users and paying users. Just to give you a negative example, the metaverse, all of us have heard about it. Media was crazy about it. You heard it even in the general interest media that usually don't talk about tech at all. People were pouring billions into building ecosystems. They were buying NFTs, just parcels of land that turned out just to be an entry into a ledger that could be easily, so the land could be easily replicated at the end of the day. And then you had, ecosystems that were worth 10 billion, $20 billion. But then you have 30, 40 users, and this is a warning sign. So I think much more, so you have to track public opinion and the industry press, but much more important is really the adoption. Are people paying for it? Is it delivering productivity enhancements to them? Is it delivering them cost reductions, especially for corporations? So these are, I think, the golden standard to look for.
Jerry Maguire, wasn't it? Show me the money. And actually, it's a great point you're talking about the metaverse, because the metaverse had its incredible hype. And in fact, the metaverse was the second generation of failed hype, which was built on by, you may or may not recall, Second Life, which was around about the turn of the century, was going to be the absolutely greatest, biggest, most incredible thing. And it too fizzled into a very odd little corner of the internet, which has, well, not gone away completely, because these things never do, but nonetheless remains a very, very, very micro niche activity in terms of numbers of warm bodies that are willing to pay for it. Very, very good points all round, I think. So Igor, just before we get to our final question of the day, round us out here. Give us a little bit more TLD on what you think are the key issues arising for tech investors and how they can use your book.
So the key issues for tech investors are, first of all, getting the technology right. So I think this is the most important thing. How do you separate a successful technology from a not successful one, especially in a given timeline, right? So timing is really, really critical. And that's why I just mentioned adoption. But there's a number of indicators where you can actually see, okay, is this thing taking off? Or is this, something that might be around for another 10 years until I see any kind of return or interest? So I think it's really important to understand also this technological perspective. So there's two kinds of cycles. One is the market cycle. This is the thing that everybody's talking about. But beyond that, there's also the technology cycle that basically tells you how mature tech is in terms of technological basics, but also in terms of market interest and market adoption. I think this is really the most critical thing to track. And this is, I think, what I also try to illustrate in the book, how you get this spot in the timing right and how you can use those cycles that are true basically for most technologies in order to make an informed decision.
Igor, therefore, we come to that most important question that we ask all our guests at the intersection of technology and markets. Igor Pejic, where do you think the capital market revolution goes next?
Well, I think it's far from over. We've seen so much development in the past years and decades by now, but it's far from over. It's an extremely exciting time. I think in the near future, a lot is going to move on chain. I think blockchain will be the next layer, settlement layer in particular. And we will see especially not only native on-chain assets, but also real-world assets or RWAs tokenized increasingly. I think that's the next step. And apart from that, I think we will see an acceleration of what is happening because of two things. On the one hand, because technology is always recursive, it builds on each other. And at the same time, we have so many now groundbreaking technologies maturing at the same time. And it's very, very difficult to understand the side effects and how they might fuse and merge with each other. So I think that the next couple of years it's going to be blockchain-based assets, and beyond that, there might be a lot of very, very interesting things that we don't even have on our radar yet.
The revolution lives, ladies and gentlemen. Thank you very much, Igor Pejic. Obviously, at the intersection of that is how to go around tech investing, which is why your book is so timely. Tech Money, a guide to the new game of technology investing, is going to be in bookstores in a few months' time. I'm delighted you could join us for a little bit of pre-publicity here, Igor. It's been really, really a joy to chat and look through all of your different charts. That's our show for today, ladies and gentlemen. We're going to be back next week, same time, same place, for IPO-VID number 203. That's going to be with our old friend Daniel Davis, the head of marketing and sales and business development for Connemara EP3, who themselves are in many ways delivering the futures of markets, and we'll be discussing predicting the future of market tech. My name is Patrick L. Young. I want to say a huge word of thanks today for our fabulous team here, AJ, Desiree, and Herminia. Thank you so much for your production. Once again, thank you to Igor Pejic, who joined us from Vienna for this fabulous discussion about his new book, Tech Money. Remember to pre-order that right now on Amazon, ladies and gentlemen, so we can get them up the sales charts. And from me, Patrick L. Young, I want to wish you a great week in life and markets. And of course, don't forget, join us at exchangeinvest.com for the water cooler of the Bourse business, the exchange of information. And also, if you've got a marketplace or exchange that you're looking to have built, then get in touch, because that's what we do during the day when we're not making short videos, live streams, or indeed producing the related Exchange Invest content. Ladies and gentlemen, I wish you all a great week in life and markets.